Hello guys and welcome to my channel. In this video, we'll be talking about Sam Bankman-Fried losing $16 billion in one day. Unfortunately for him, Bankman-Fried makes history by losing his entire $16 billion fortune in just a few days. The Bloomberg Billionaires Index now values FTX US business, of which Bankman-Fried owns around 70% at $1. The collapse of the FTX cryptocurrency platform has swept away in just a few days of the enormous fortune accumulated by its founder, Sam Bankman-Fried, one of the best-known figures in the sector and whose assets were estimated at $26,000 million. Can you imagine creating a multi-million-dollar business that allows you to achieve a fortune of $24,000 million and then lose almost everything in a single day? Well, that is what the American Sam Bankman-Fried, better known as SBF, the co-founder and CEO of the FTX cryptocurrency exchange, seems to be going through. Sam Bankman-Fried, who is 30 years old, entered the Forbes list of the richest people in the world in 2021 and continued there in 2022. According to the last ranking registered in April of this year, his net worth of $24,000 million positioned him in the 60th place of the biggest billionaires. Such records indicated that his fortune came from the FTX exchange founded in 2019 and its investment fund Alameda Research created in 2017. However, with the rumors of insolvency that have been around both companies in the last week and later confirmed by SBF, forecasts indicate that his net worth fell sharply. Sam Bankman-Fried's fortune collapsed. In the last few minutes, Sam Bankman-Fried disappeared from the list of the nearly 2,500 richest people in the world recorded live by Forbes. And according to Bloomberg estimates, he lost 94% of his net worth in a single day. The outlet calculated at his peak, Sam Bankman-Fried's net worth was as high as $26 billion, but he forecasts that it fell to $26 billion earlier this week and then to $1 billion by the last day, which he says represents the biggest billionaire's crash in 24 hours. Thus, according to forecasts, SBF lost most of the fortune that he planned to donate to charity under his altruistic philosophy of earning to give. Although until now, he had not materialized this plan except for donations of less than 0.1% of his wealth, according to Forbes records. FTX crash leads cryptocurrency market down. The crisis that FTX is going through has impacted the cryptocurrency market, including Bitcoin, which fell back to its 2-year low. This while FTT, the FTX token, has fallen almost 90% in 3 days, and fear intensified among traders in general in the ecosystem, as reported by Crypto Noticias. Added to this, the CEO of Binance, the largest cryptocurrency exchange, announced that it will acquire FTX to cover the liquidity crisis they are going through. In this context, FTX went from being the third largest cryptocurrency exchange to fourth, according to data from CoinMarketCap. When did the so-called financial genius SBF fail again? When FTX CEO Sam Bankman-Fried took to Twitter on Monday to assure depositors that liquidity at the third largest cryptocurrency firm was fine, one could be forgiven for hearing the echoes of the Bear and Lehman plaintiffs talking to NBC to assure their respective funding sources. Their short-term lenders and their liquidity was also fine, when in fact their own companies were in their that sense of foreboding was temporarily eased when it was announced on Wednesday that Binance, the largest cryptocurrency market, would bail out FTX by absorbing it in an acquisition reminiscent of the one that saw JP Morgan gobble up smaller Bear Stearns during the start of the great financial crisis. However, after a few hours of Binance due diligence team going through the book of its rivals, it was announced on Thursday that the deal had been cancelled. As a CoinDesk report from the previous week had noted with concern, FTX had put much of its depositors' money into hard-to-sell positions. These included large equity stakes taken over the summer in troubled crypto players BlockFi and Voyager, as well as large loans to one of the other SBF companies, Hong Kong-based cryptocurrency trading firm Alameda. Facing a $4 billion shortfall, the company announced Friday that FTX and all its related companies were filing for bankruptcy. It was the biggest collapse for a cryptocurrency trader to date and prompted a sell-off in cryptocurrency markets, already hard hit by rising interest rates. The irony that Binance was the first to offer salvation before taking it away was not lost on informed observers of the cryptocurrency space. After a series of public discussions about the perceptions of SBF's friendliness towards financial regulators have gone too far, Binance's announcement that it would start closing its large positions in FTX helped spark the race that ultimately killed the firm. The problem, aside from the imminent withdrawal from Binance, was the signal it was sending to the market. Selling his holdings in FTT, the digital token underlying the FTX network, valued at billions of dollars at the time, would plunge the price. If you know a whale is going to sell, it's better to get out first, and that logic led to huge pullbacks. For its part, meeting these customer requests for cash became increasingly difficult for FTX. Even if he had been able to access the FTT he had loaned to Alameda, which was used as collateral for trading counterparties, selling it for cash at crisis prices would likely have blown both companies up. For one thing, selling off so much FTT would have plunged the price, putting FTX in dire financial straits, like Bear and Lehman, whose home equity houses collapsed when a sudden panic over their quality meant the positions were effectively unsaleable and would not be taken as collateral. FTX and its related companies had no assets they could quickly sell for cash and no collateral that any counterparty wanted to take. From being worth billions to being bankrupt in less than a week, given the similarities between the FTX implosions and the financial crisis other companies have faced in the past, several recurring lessons seems worth pointing out. Who did SBF suspect for FTX collapse? FTX collapse was engineered by Changpeng Zhao, head of rival Binance, whose strategy may have worked better than he expected, says Sam Bankman-Fried, the founder and former chairman of the cryptocurrency exchange that now operates under court protections from bankruptcy. During an exclusive interview with Forbes, Sam Bankman-Fried, founder of FTX, arrested in Bahamas. Criminal charges are being filed against SBF by the US. Zhao, widely known as CZ, which FTX highlighted with a November 6 post on Twitter, in which he said he would liquidate tokens issued by the Bankman-Fried exchange due to recent revelations that have come to light. That exacerbated market concerns about FTX financial health and was followed by a hastily withdrawn ransom offer from Binance 3 days later. Bankman-Fried says that, in hindsight, he doesn't think the offer was legitimate, in part because CZ cared surprisingly little about the terms, including the price. FTX filed for bankruptcy on November 11, and Bankman-Fried says multiple rescue offers arrived within hours afterward, most of which took the form of loans that could be turned into equity, much of it from outside investors. During the 2008 financial crisis, Warren Buffett supported the troubled Goldman Sachs in a deal that included preferred shares and convertible warrants. Bankman-Fried blames poor legal advice. The terms were quite favorable for potential lenders, he adds, but most would have allowed him to stay with the company, albeit under the supervision of a senior executive. Bankman-Fried has said that its lack of attention to risk management was one of the reasons for FTX failure. Bankman-Fried, who had majority control of the FTX companies, says he was pressured to resign by a very tight-knit group of lawyers and law firms who were coordinating with each other. He said he could not discuss his motives but cited some $700 million in legal fees associated with Enron's bankruptcy. Bankman-Fried did not further identify the lawyers but repeated earlier claims that it almost immediately regretted agreeing to resign and seek bankruptcy protections and that the company's U.S. subsidiary, FTX US, was solvent and should not have been listed. In the presentation, in previous interviews in recent weeks, Bankman-Fried admitted that client funds were not properly segregated and that led to a cash crunch when FTX was overwhelmed with withdrawal requests. What has the FT collapse taught us? First, maintain a diversified balance sheet. Much of the panic that causes movements between asset classes to go on is because companies realize the instability that large undiversified counterparties bring to the system. From long-term capital management's short positions on stock volatility to investment banks going all in on their subprime mortgage securitization businesses, a lack of high-quality liquid assets will always leave a company in the dark, razor's edge. Second, when credit conditions start to tighten, companies have to deleverage or carefully manage their liquidity. Neither of these things happen. Third, When you deposit money in an institution, you are making a loan. The interest rate, therefore, should be considered an indicator of the level of risk that a depositor is assuming. For crypto lenders, which operate without the safety net of the Federal Reserve, the interest rate offered to attract lenders is typically several times higher than what could be obtained at a traditional depository institution. The reason, as has just become apparent, is that these companies are paying buyers to bear the risk of a total loss of principal. Fourth, beware of obvious conflicts of interest. Just as the fact that rating agencies were paid by banks for their ratings and had to compete with each other to retain the lucrative business of the big banks should have been a red flag. The role of SBF as free boss of charges from both FTX and Alameda deserved much more scrutiny than it got. Finally, it's not just dumb retail investors who are exposed to heavy losses. Several large institutional investors face combined billions of dollars in potential losses. This smart money made all the classic mistakes that have seen banks, from UBS and Credit Suisse to Merrill Lynch, get into a lot of trouble before. Related hedge funds or special investment vehicles that could expose a lender to loss must be carefully monitored and by at least 2 different people. Drawn by a story told by a charismatic young entrepreneur, all these investors pursued performance at their own risk, whether they knew it or not. One can only hope that the inevitable calls for more regulations of the cryptocurrency space and an expansion of the powers of the Consumer Protections Bureau are deterred by cooler heads, who recognize that there was nothing all that special about the death of FTX in absolute. Now you have seen it all. What are your comments about this video? If you like this video, hit the like button and smash the bell icon for more notification. And don't forget to subscribe to my channel to get more videos like this. Thank you and hope to see you in the next video.